So do you remember what a scorecard is from our last class? Do you remember?
Not really.
Okay, so with the scorecard, this one spells out what things we should consider most, what are more, what targets are more important than the others. So it helps you in setting a scorecard to know what can you consider now, what can you take on now, what can you a little bit delay. So as you're setting targets, there are some things that you must consider, measures that you need to consider or put in place, such that they can guide you in the process of setting different targets and strategies. So, so management is supposed to consider the critical success factors, which of them are more important, or what factors must you consider to be able to achieve your aim goal or your vision and target. Then you should also consider the KPIs. What KPIs must you take more seriously than others? Then you also look at the targets. What targets have you set? And which KPIs can you be able to put in place to enable you achieve those set targets? And then lastly, we can also consider the initiatives, the actions that we could put in place to ensure that we improve our performance and ultimately be able to achieve the target and goal that we have set in the company. So there are some indicators that will show, of course, that will be indicating either if we are leading or we are lagging in what we're supposed to attain. Lagging is more like the negative part, or we can also call it the downstream. It means you're not achieving what you're supposed to achieve.
Okay.
So with lagging, the indicators here will show the effects of the decision long after they were made. So when you're doing a scorecard, for it to be balanced, you need to refer to the KPIs, identify the KPIs that are leading to lagging indicators, because they will help you to measure the impact of the action taken in the past. So you can be able to trace back and identify why there is a downstream happening. And then for the leading, what we would call the upstream, here the indicators will drive future financial performances. So this might be non-financial KPIs. They could be giving us information relating to customers, internal business processes, and learning and growth. So you have to know that with leading, we are looking at something that is going to that is we are focusing on for the future. What we aim to, which groups we are aiming to look at more. Maybe the customers. There could be different processes that we can put in place. But with lagging, now we have to use KPIs that can help us trace back with things that happened in the past. If we are a production company, for example, we want to put in place KPIs that can help us to focus for both the future, but also not forget what happened before. So for the future, we can say we want to improve it, to have a better quality in place of products. We also would want to have maybe improved customer services. So you can say we'll give each customer quality time, we'll do after sales services, or we can inquire from them. So we're trying to look at building for the future. But then when we're looking at lagging or the downstream, here we look at KPIs that will be showing information from the past. For example, is it something something to show you maybe the previous targets that you had set, how you had planned to achieve certain goals. So it was giving you something. They will link you to the past so that you can know what was happening in the past and in the forward. Let's say economic order quantity. What was the economic order quantity 5 years ago? How much production were we doing then? And how was our market like vis-a-vis? What are we looking forward to? So the lagging will show you the previous information, the leading will show you the upcoming or what you can focus on for the future. So it's very important to consider them both. Then let's look at now the advantages and disadvantages of having a balanced scorecard. When you have a balanced scorecard, first of all, it will help you with a wider view of performances of an organization. You can see different performance indicators at the same time, or it will portray feedback or information regarding the different KPIs that you've put in place and how maybe they are performing, what has been attained, and what is still lacking. So it makes it much easier for you to analyze different things at the same time. A balanced scorecard also helps management to be able to concentrate on the most important aspects, so they do not have to waste more time on being confused on different other projects that may not be extremely important, or even taking on excessive number of performance indicators that may not be attainable, or it doesn't make logical sense for them to be attained at the same time. Then it also helps in measurement of objectives of the organization, and as a result we can be able to use that as a strategy for an organization in achieving the entire set objectives. So it's very important that the management can be able to have a well-balanced scorecard to help them minimize a lot of time wastages and have a situation in control. Then on the disadvantages, it makes it difficult to identify the most appropriate KPIs. How? As an organization, you want to have an all-round achievement or an all-round performance. If it is in terms of let's say sales services, after-sales services, quality, maybe time management for staff, maybe timely reporting. So there are quite many. So when they say choose what is very important for you, it may be a little difficult for you as management to say that let's consider these particular KPIs and leave the others, because you want to attain almost all of them. Then it also focuses on the needs of two stakeholders, who are the owners and the customers, and it tends to ignore the employees who are in the other groups, and maybe some other stakeholders who are not the owners and the customers. So it's more focused on achieving the goals of the owners and the customers. Then it's also having a balanced scorecard will need training for management, especially if they have to do a change in culture, doing things that they've not been doing in the past. So that will take more costs for training, and it will be a little difficult if there is a need for change in culture, because adapting will take some more time. So those are the challenges of having in place a balanced scorecard, but they're not quite difficult. Sorry. So that was the only part that was remaining in the previous chapter. I think we can be able to proceed with the next chapter. I had wanted us to do one example that had calculations. Let me just a second. Let me see one that is already computed. Okay, let's go through this example and then we can begin the chapter for today. It's activity 3 on financial performance measurement. So well-heeled a children's shoe shop located in a suburb of a major capital city. The shop was started in 2007 and quickly established a reputation for high-quality children's shoes. There are no other shoe shops in this particular suburb, but there is a large shopping center in the next suburb 5 kilometers from WH with several children's shoe shops. The retail space next door in WH became vacant at the start of 2010. Because this was also owned by the same landlord, WH decided to rent this space too, expanding the area of the shop from 40 square meters to 60. So this is a business decision that has been made, and maybe it could have an impact on your answering. The company employs one full-time shop assistant and starting in 2x10, an additional assistant to work on Saturdays. The company employs one full-time shop assistant and starting in 2x10, an additional assistant to work on Saturdays. So this is now, we're having a second assistant coming in place. What does it show? Extra costs to the company, the owner, and maybe it can also indicate maybe increased number of clientele. So we have to have more people to attend to them. The owner of WH also works in the shop but does not take a salary for her time. The country in which WH is located was hit badly by an economic downturn in the first half of 2010, but started to recover in the second half of 2010. Inflation in 2x9 and 2x10 was 2%. So we've had an economic recession. The income statement for the year 2009 and 2010 is presented as below. We have the sales, we have the cost of sales, and the gross profit. This could be important. We have expenses where we have the staff costs, we have rent, marketing, light and heat. So we have these as operating profits. And what are we required to do? They are saying assess the financial performance of the shop using the information above. So we want to know how is the company performing in the 2 different years. Well, we see the profits, there is a growth. What is happening to the sales? The sales are almost getting double from 180 to 240. The cost of sales are also increasing as expected, and the gross profits, but the gross profits are not increasing much significantly because the sales are from 180 to 240. That's a difference of about 60,000, but the profits are increasing by 12,000. We have costs because in year 1 we had 1 person, now we have 2 staff, that's 30,000. The rent is increasing because of the increased store we are taking. Marketing costs, these are for increasing sales, and then light and heat because of the additional space. So what can we use to be able to assess this information? Are there any ratios that can come to your mind that we can be able to apply? Please feel free to unmute so that we can do this example as fast as possible. Yes, Jen?
Gross profit margin, you can compute it.
Yes, we can do the profit margin because we are given the profits. Okay, so we have gross profits. Let's do 2x9, 20x9, and we have 20x10. So if we say gross profit, we can do gross profit. And what was the formula?
Gross profit out of sales revenue times 100.
So it is equal to gross profit out of
sales revenue
times 100. So this is in brackets. And this will be like this. So what was the gross profit for 2x9? We have gross profit of 60,000 and then 720. And here we have 720. This is the gross profit. And what was the sales revenue? We have sales, and this is 180 and 240. So for us to arrive at the margin, we'll get the gross profit. We'll divide it by the revenue. And we'll make it a percentage. That's 33%. And what happens in year 2? D6 divided by D7. This is not normal. It's like this, 30%. So much as the profit was increasing and the revenue was increasing, the profit margin was dropping. So as we're advising management, does it make economic sense for them to, so when you're advising based on one ratio that you've computed, you will say expanding of the WH shop does not we can say leads to an increase of sales revenue by 12,000. However, it reduces the profit margin by 3%. So as managers, if we are trying to advise, it means this would not have been basing on this. We can say basing on profitability, ability drop, expansion was or does not improve the company profitability, but in the future it could increase the business visibility, hence increased clientele, as marketing is also being focused on. So this is an example. I'm just using one ratio now to give, but of course now for us to come to a conclusion we would have done a number of ratios. Maybe we can do another ratio. Now we have We can also use the operating profit to see what if the gross profit is in the same rhyme as the operating profit. So we can say, maybe we can call this number 1, can let's do number 2, and number 2 we are going to do operating profit ratio. What was the formula? So it is this, using the net profit. So it's profit for the year, we divide by revenue times 100. And what was the revenue for the year? Sorry, the net profit. We had 33200 and sorry, it's 26800 and 24000. So we will get the operating profit, we divide by the sales revenue and multiply that by 100. So if we make these percentages, we see that this is also dropping. So that's the gross profit ratio is in the same line with the operating profit ratio. So it means that vividly in 1 year, however much they have increased the space, the office space, they're not having significant profit because now they're also spending more, and the sales are not also increasing as much as they should have increased. But apart from that, there could be other factors. Maybe the company, we're told here in the scenario that there was an economic downturn in the first half, but then there was a recovery in 2010. So this can also guide you when you're doing your discussion. And how does this guide you? So you can say the financial figures could be showing that there is this does not bring into a financial benefit to the business. However, this could have been as a result of the economic turndown. This could have led to the decline in the profitability ratios. However, since the economy is now recovering, they could expect to earn more profit, more sales, and maybe also be able to increase these ratios. So we look at it both ways. That's how we do the discussions. Does it bring highlights? Does it bring highlights, or do you want us to do an extra ratio? Okay, so now let's proceed with the next chapter for today that we had intended to cover. Okay, so our next chapter we're going to look at budgeting, forecasting, and control. And these are not new terms. We've seen them multiple times. Budgeting, we're trying to look at something in the future. We're trying to do a plan. That is with also forecasting. So under this chapter, we're going to look at the cost control systems that we have in place so that the company can use. We'll look at the alternative budgeting models, the forecasting methods that the company can use, and then also the standard costing that is available. So, cost controls initially, or from what was first developed.
We can't hear you.
You can't hear me? Can you now hear me? Cecilia, can you hear me?
Yes, I can now.
You can, eh? Okay.
Yes.
So I was saying the cost control systems that were first developed, initially we had to look at budgeting, we had to look at the standard costing and the variance analysis, and then the cost methods that could be used. For example, we had the absorption costing, we had the marginal costing. These were there much before, but with time there is an evolving that is happening in day-to-day basis and also in the business world or the business environment. So the business now has become much more dynamic, and so they have to put in place things that can also be able to match the dynamics of business that are happening. So apart from now doing budgeting and looking at costs and all that, the different things that now the company can be able to look at to ensure that they can be able to sustain their performance or their existence in the market. You might have a good budgeting, but then at the end of the day, it's also not reflecting much. So there's been an increase, for example, in the emphasis of quality. Different industries are producing different qualities. So there is competition in terms of quality rather than cost. So now costs can be seen as less important than from a strategic perspective. Why? Because now costs, you might want to minimize the costs, but then you're not selling. And at the end of the day, it means if you're not selling, you cannot be able to increase your visibility, you cannot be able to increase your clientele base, you can also not be able to increase your sales revenue. So instead of focusing on how you can reduce costs much more, now you'd have to look at things like how can we be able to achieve this quality. So it doesn't matter how much we'll spend, but we need to get the best raw materials to be able to produce the best quality products. Then look at things like technology as well. In the previous times, technology was not something that was extremely important. But now, with technology in place, there has been a new way of doing things, in doing business on a day-to-day basis, and it keeps changing and evolving. So with having technology, of course, it helps with having in place opportunities, but not forgetting that it also brings threats to the businesses. So now we have to also identify if we have new technology happening, do we need to change our products? Can we still be able to serve this same market with the same products, or do we need to keep evolving with the change in technology? If we're using BlackBerry phones maybe a century or 2 centuries ago, are they still valid? Oh, now technology has evolved and everyone wants to use a smartphone. So can we now change our product from a BlackBerry to introduce to maybe doing a smartphone that can be able to sell? So that's how in the business world, the dynamic business world, different things are changing other than budgeting and focusing on how to minimize costs and how to forecast things that were just generic, or okay, not generic, but they were a little more basic. Then now we have an increase in the services sector. So in the service industries are now becoming much larger, and they take a larger share of the economic activities in the current business environment. So it means with now having more service providing companies, as companies would not have to focus more on standard costing, because now this will be it will be a bit less relevant. How now you would be focusing on how can we be able to thrive if you've been an accounting firm, for example, an auditing firm, and maybe 2 centuries ago you were only 3 or 4, and now you go to check and we have about 20 other extra service providers. Competition is becoming tighter, so now you then want to still continue looking at how we can cut costs, but now how can we continue to thrive and keep our name and still grow other clientele, maybe get into different regions, have more clients coming on board, other than you wanting to save what you have already earned. And then increasing outsourcing for many business processes. This shows that businesses rely on their suppliers by keeping costs under control. So what does that mean, or how does that impact us as now the business environment? So it means now you don't have much control on the costs that you're going to incur, because now that your supplier will be the one to determine how much you will pay them in terms of price of the raw materials, for example, or the products that you've manufactured that you're going to consume. So here you have to emphasize on other things like the quality of the products that you're manufacturing or that you are delivering. Maybe are you able to deliver on time so that you can be able to satisfy your customers? They don't have to move to outsource different service providers because you cannot be able to supply them on time. So you'd have to focus on these other than only looking at costs. So with the evolving or dynamic business world, different things keep changing, and so must we keep changing to be able to fit in the dynamic environment. And it's very important for us to keep relevant. Otherwise, it means you're going to close the business at the end of the day if you're not going to keep relevant. So now let's look at the link to the strategy. How does this link budgeting? How does budgeting link now to strategy? So as a company, remember we've set missions at the start to be able to set a tone or the direction of where the company is going. We have a mission, we have a vision, we have objectives that we've put in place, and then we've designed a plan on how we aim to achieve these different objectives. Likewise, we'll have to put in place a budget that can be able to guide us to ensure that we do not get off track, we do not spend too much, so we can keep at least within the budget. So the mission mainly was for giving us the direction. The objectives were also there for giving us a long-term goal so that we can keep focused. Then we will have plans that we will need to follow to ensure that we get to the set long-term goal that we have put in place, not forgetting that the budgets are very important for both the short term and the long term, but mainly importantly for the short term, to ensure that we are still in the financial targets that are available. We're not going to run the company bankrupt in the name of achieving one particular objective. So what are the advantages of having to budget? The different advantages that come in place when you're doing budgeting for an organization, or even look at it from the individual part of view. If you do budgeting, maybe my income for the month is, let's say, 1 million. just giving an example. And then I need, let's say, rent this much, I need transportation, I need meals. So you have an overview in your mind, so you know what your limits are. Likewise, for an organization, if we can be able to sell only this much, this is the only revenue we can be able to access. So it means we must be able to plan in the same circle. You cannot have a cash availability or resource availability of 1 million, and you're budgeting to spend 2 million. How do you expect to get that 2 million? There should be something supporting that figure that you're trying to put across. So budgeting helps us in having that picture, or having an umbrella that we can be able to operate under. We know what we can afford, what we cannot afford, what we should focus on, what we can do to get better, what can lead us to the next step. So it helps us in thinking for possible identification of short-term problems and how we can be able to solve them. For example, how much can we be able to produce? If we have machinery that produces 1,000 units per hour, how much can we be able to produce for the 5 working days? How much can we be able to supply? How much can we be able to sell? So it helps you get organized early enough, and you can be able to see if there is a capacity that could have a shortfall, or the capacity that you can be able to maximize, and then you can be able to solve those problems as they arise. Then they also help us in coordinating between various departments of an organization, between the finance department, the sales department, maybe the procurement department, the production department. We are able to get unified and get to know what is our ultimate goal and what is the availability of funds for us to use. Budgeting also helps in motivating managers to perform better. How does this help them to perform better? If your sales target has been maybe set, maybe previously we were achieving, we can say maybe 100,000, and then we're saying for us to be able to get the money to finance this and this and this, our sales must be 3 times more. So we need to produce we need to be able to sell as much as 300,000. So as managers, what is that communicating to your mind? It means you have to sell more, you have to market more. If you're producing, means you have to produce more. So you're making decisions that now are going to have to be focused to that objective of having a better performance. So that aids management to be more focused, and so that they can be able to be motivated to work better. Then budgets also help in providing a basis for systemic control, mainly because we management want to have control of performances of staff members, of different perspectives that contribute to the company's performance. So if you have in place a budget, you know what to focus on, you know what solution or what procedure you can put in place to be able to curb what the control that you're intending to focus on. So that happens with the help of budgets. They also help us in having in place a system of authorization for managers to spend up to a set limit. We've seen where we have, I think we can see maybe an example of per diem. Maybe per day, if you step out of office and you're going to meet a client, you're per diem of this much. So as management, if we are saying we must not spend above, let's say, 100,000 per day. If we have someone that needs to go and visit different people, do they need authorization to ensure that these people don't spend more than what we have? So you can say maybe before we give out, before the cashier pays the money, maybe the supervisor will have to approve. So you can know if the movement is actually necessary or not necessary. Can you be able to do it from office or not? So it helps you to be able to have a spending limit and ensure that you're in the limit, you're in the set budget. You're not going to spend much more. So now let's look at top down and bottom up budgeting. So in top down budgeting, this is budgeting that is done mainly by management. So it begins from the senior management and then it gets downwards. Then the bottom up budgeting, here the budget begins from the managers who are from below. Let's say each department management head can be able to prepare a budget for themselves, then they can present top management for approval. So that's the difference between the two. With top down budgeting, the budgeting is done by the top management and then it is brought down to the junior managers. With bottom up budgeting, the junior managers can be able to prepare budgets for their different departments, for example, and then they will present or submit them to senior management for approval to be able to consider them. We also have fixed and flexible budgets. Fixed budgets, usually they are, as you hear the word fixed, maybe you can say for a particular period. For a particular period, we have let's say a budget of this amount that we must work around with, and it is fixed and nothing is changing. Then with flexible budgets, here we have some things, we have a chance of maybe some things changing. It could be maybe costs, it could be revenues, it could be time period, it could be any item that you have seen present in the budget. Then we have rolling budgets. These are also looked at as rolling forecasts. With rolling budgets, these ones are prepared in advance for the full budget period. If you're, let's say, you've seen, for example, maybe the government, before we begin a financial year, we have a budget that has been prepared for the financial year ahead. So that's what the rolling budget forecast looks at. We are looking at something for the future and we're preparing. Now we are preparing ahead. Sorry. So with the rolling budgets, the systems of budgeting will the systems of budgeting could have a situation or in place of where the budget can be continuously updated. So it could either be you can say, for example, we're going to do a budget from January to March, maybe the first quarter of the year. You're budgeting ahead for 3 months. Maybe, or you could say after 3 months we'll do an extra budget for another 3 months. So we can say at the end of each month we will do an upfront budget for the next month that is coming ahead. So you could change it, or it could also be maybe you do a full period from let's say January to December, or you do January, then at the end of January you do February. So it keeps getting updated over time. We also have incremental budgeting. With incremental, this is like continuous, it's like addition. So we begin with the previous period's budgeting or the results that were actually attained, and then we do incremental amounts for the changes that we know will happen in the business. Maybe, for example, inflation, or maybe prices or costs because of a project that is coming up. So we do incremental amounts. We keep adding on top of the actual results that were there for the previous period. We also have a zero-based budgeting. And the zero-based budgeting mainly is prepared to overcome the weaknesses in the incremental budgeting, which does continuous additions. So with zero-based budgeting, the managers can plan what they wish to do. Maybe they're saying in this current financial year would want to increase awareness, so maybe we would want to do extended or intensive marketing. Then based on that, you can be able to work around and see what do you need. Do you need maybe additional staff? Do you need additional marketing expenses, maybe in terms of transportation to different locations? Do you want to run different programs, let's say on televisions, on marketing platforms that are available? So you look at that. Instead of basing on the actual, here now we begin from a blank sheet, and then we see which projects do we intend to undertake and how can we be able to plan ahead and come up with an estimated figure of what we'll need, which is different from the incremental where we are having the previous month and then we keep doing additions. We also have the traditional budgeting, the criticisms of traditional budgeting. With traditional budgeting, this is what we were doing previously, and the challenges that have come along with it. For example, budgeting takes too much time. If you're going to do a budget for a full year, you will need, let's say, some ample time. It could be 2 weeks, it could be a month, depending on how many people and how skilled they are in preparing such a budget. So it takes much time of the management, especially the senior management, to be able to analyze every other figure that has been presented based on that. Because now imagine if you're going to do budgeting, first of all you need to know what are the objectives that are coming up for this upcoming period. Is it the sales? Is it the marketing? Is it do we have how is the economy performing? Do we need extra resources? Do we not need extra resources? If we need,
Hello.
yes, hello. So all that, put it into consolidation, will take a lot of time. Then traditional budgeting also have an extent of gaming, because these budgets were initially introduced as planning tools, especially for in terms of managing costs and cash flows. But now, as businesses change and as times change, budgets are also used as performance management tools, or they can also be used for managing the businesses. So how does this affect the management or the company at the end of the day? So it gets you to a performance trap. If you said our budget is to increase sales maybe by 10%, and you don't achieve that 10%, or you've not yet even started, it means you're committing into a performance trap that you must work as much as you can to be able to attain this set figure. And that could even be used as a benchmark, maybe for you to analyze your performance, or maybe give you salary increments. So it gets you into a trap that you must work with, that you must deal with, to ensure that you can be able to achieve that. We have a beyond budgeting model. And what is beyond budgeting? When when we are looking at budgeting and beyond, what comes into our mind, or what are we trying to look at? So here we tried the beyond budgeting. It's a set of guiding principles that will enable the organization to manage its performances and also to help in decentralize its decision-making processes without the need of traditional budgets. So we're trying to look at guiding principles that will help us to be able to manage our performances. So we're not only going to look at budgeting for costs, we're going to look at something much beyond the costs themselves. So we're trying to see how we can get a better performance, how we can make better decisions, other than looking at what was looked at in the traditional budget. So this will of course lead the organization or management to stretch themselves to be able because with budgets now you're stretching yourself to set better goals or to be able to grow, show that you're working harder, you're growing. Like for example, if you've been selling 1 million and you're saying we would like to, or because with economic boom we're going to the budget to increase our sales by, let's say, 20%. So it means now you're setting a new goal and you must work extremely hard to be able to achieve that goal. So in the long run, of course you're pushing and stretching yourself to be able to get to that limit. So there is an activity about budgeting. You'll go through it and then it can help you understand budgeting better. Let's look at now linear regression. Okay, so we've seen linear regression before, I think in mathematics. We did a lot of it in financial management. It was something that was done quite often. So with regression analysis here, we are looking at the quantitative techniques that we can be able to use in estimating the relationship between one or more independent variables. So we could have one independent variable and a dependent variable, and then we can see how the relationship is happening between them. If one increases, for example, does the other increase, does the other decrease, or does it remain constant? So there is an equation, and the equation that we use is y is equal to a plus bx. The y is the dependent variables, the x is the independent variables, and then the a is the value of y when x is 0. So you input the figures and can be able to do the computation. So for SBL, I think that is all you would need to know, because you will not be required to do the computation for linear regression. Okay, so let's look at time series analysis. So time series analysis here, it's a technique that we use in where we use an ordered sequence of past values of a variable at equally spaced time intervals to distinguish seasonal and other cyclical functions from long-term underlying trends. For example, you can look at maybe employability statistics or employment statistics. We can look at maybe business confidence statistics. We can look at consumer confidence statistics. All these we can be able to trace them using a time series. We're trying to see what's the time frame. Is there a relationship between the increases and maybe the decreases? So we're trying to understand what the time series or what time can be able to predetermine. We look at the past and then we can be able to estimate what is most likely going to happen in the future. So that is it about the times analysis. There is also an example. You can be able to go through it so it can give you better guidance. Let's now look at standard costs and variances. So standard costs, these ones are usually predetermined costs, or we can say these costs help to give a benchmark or a yardstick against which to measure the actual performance. However, we also have variance costs. These ones, they keep changing. So to get the variance, we'll get the difference between the actual costs and the standard costs. Standards can be set. Maybe, for example, you can say we're going to have selling prices for these particular items, and then we're also going to have the costs that will incur for these particular selling items. So those can be variables. They may not be a constant. So if we have set in place and we say our target for this year is to have profitability of, let's say, 30%. To be able to achieve 30%, maybe we're going to have a sales price of, let's say, 1,000 shillings. On that 1,000 shillings, for example, we had the cost of production, which was, let's say, 300 shillings per unit. So we know the difference between the two. The 700 is going to be the actual profit. So it helps, that will help management when they are trying to do to check the variance. What is the, if we've set the profitability to be 7 and there is any difference occurring, management can easily get aware and then they can be able to plan ahead. So that is it about the budgeting. So now let's look at a different part of the same. A different part of the chapter. I don't know, are there any questions for me? Any inquiries before we proceed? Okay, so if there are no questions, then we can be able to proceed.